Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Thanks for joining us on the Smart Property Investment Show. I do enjoy doing this. One of the highlights of my week is getting face-to-face with property investors. They come from all over Australia to join us in our studios here in Sydney to have a chat about property, what they're up to, what their fears are, their ambitions, what they could do better, what they could probably do less better, and how they might be pivoting and changing as they go down this journey of wealth creation through property. Way back when, in 18th of March, so at the start of this year, I had a gentleman in the studio. We had a really good chat around his attitude and aptitude towards buying and where he thought the future lies. So I've got him back into the studio to have a chat with me. Let's see how he's gone on those plans that he outlined then. Scott O'Neill. Hey, B, mate, what's been going on?
Oh, good, mate. I've had a child 4 weeks ago, so battling with the lack of sleep at the moment, buying a few more properties, just working hard in the business and new family life. So
yeah, that's good. Like property, everything's always evolving. Is a child going to slow down your property investing, do you think?
No, you just got to prioritise things. So I think your weekends have a different meaning. You know, work's almost like a holiday now. Yeah, I don't know. It's just different outlook. You know, the work-life balance has a new meaning. So it's an interesting time, and I'm sure it's going to change a lot more over the next month or two.
Oh, absolutely. And, you know, have you started thinking now about generational assets when it comes to property investment? You're already thinking about land banking for the new child?
Yeah, look, I sort of always did. It's made me think about almost decluttering some of the properties as well, because it's all about time management. So, you know, you'd have a few properties in your portfolio that cause you extra stress. That's and the results aren't really there sometimes. So sometimes just getting rid of that clutter and probably buying better quality, you know, higher yielding stuff, which, you know, it's all about the income at some point. So, it's a different outlook, like I said.
It is, and it's only really when you get into property, start buying multiple properties, that you start thinking a lot more about property. You get a lot more educated, sophisticated the way you see the world, and you can start making those decisions, right? And hence the reason why you actually need to be able to make informed decisions. So keeping a house in order, knowing what's going on. And I've got properties in my portfolio which are just headaches, right? They never seem to have a tenant in there, and there's always something going wrong with them. And, you know, I haven't sort of cut it off and moved on, but, you know, you need to be able to make these decisions at a point in time. So be informed. So when we got together 18th of March, what were we chatting about back then? You sort of started moving into commercial stuff.
Yeah, so we did chat about commercial. I was travelling a bit at the time. So since then, I've moved more into commercial. So I've purchased 4 more commercials since then. I invested into a couple syndicates as well. So basically purchasing large-scale commercial assets, but owning portions of it. It's almost like a form of diversification. You've got bigger, better quality tenants, and, you know, you don't have to own 100% of the assets sometimes. Bought a house in Greece, which a little bit random, but weren't planning to. But again, that's probably something to do with the kid. We've been going to Greece every year, and I think just having our own place there, and, you know, it's just something different, really.
All right. Well, you give me some nice structure then for this podcast. So we'll have a chat about this Greek property and then deep dive into some of the commercial stuff you've been buying. And I want to learn a little bit more from you around these syndicates, because, again, when you get to a particular point in your property investing journey, you start getting a little bit more sophisticated in some of the structures. So we'll get into that. So let's chat about Greece. Where?
Island in Kos. So it's sort of right near Turkey on the border, about 10 k's away. I've been there 6 years in a row, and we've been staying in, you know, little places, and it just made sense.
Was it like, what'd you get, like a little fishing hut on the border or something?
It was quite a large property, like big 4,000 square metre thing with about 6 bedrooms. So the idea is to potentially Airbnb it when we're not there. There's a real good market for there. So it will, I hope, cover itself. But it's not about that. It's about
lifestyle.
You know, hopefully we've got it in 50 years and pass it on to the kids. And
why Greece? Are you Greek?
Wife is half.
Okay.
So logically, that's where
sort of
we had to go.
From that particular area? Like, is there family from that area in Kos?
Yeah.
That's just my geography. So how do you get there?
You got to fly to Athens, and then it's a flight from Athens out there. So it's literally at the very southeastern corner.
So you can go direct to Bodrum on a boat. Okay. So you've been to Bodrum?
Many times.
Good fun, isn't it?
It's really hot there, isn't it? It's funny because Bodrum, it's always about 10 degrees hotter than that island because of the ocean separation. And there's a little bit of stress with the Greeks and the Turks at the moment.
Yeah, they don't particularly get on, and they've got a lot of history.
Yeah, and I think I'm not really up to date with the politics, but I think the Turkish president is causing a little bit of grief for some of the Greeks. So hopefully they don't get taken over and I've got no property.
Well, who knows? So, but on that basis then, did you have a lot of confidence to, like, how do you hold property assets in Greece? Are they sort of like, what sort of title is it? Is it completely owned by you?
Very similar to Australia.
Okay.
It's just there's almost no email or electronic work. It's all old school posting. Got to go to visit, different departments and
Get stamps and...
It's similar, but it's very old school.
Is there any debt on it, or you just...
No, there's no debt.
Okay.
Well, you can't get it there since the GFC over there. So
okay, so you had to pay cash
to
money.
my knowledge, at least. So
did you just arrive with like a bag of cash and there you go? Like, how do you actually? I'm quite curious about the dynamics.
It's a transfer, but they do love cash. So.
I'm not stereotyping there, but it sounds beautiful though.
Yeah.
So it's there forever. You'll get over there once a year, twice a year.
Yeah, something like that. And the idea is I'm probably going to go to China over January and basically just go to the factories there and fill it with stuff because furniture and building materials and all that stuff are quite expensive over there. So
you just ship it directly to the house.
Exactly.
It just sounds like you want a trip to China and
just something to do.
What do you got to buy, like lounges and all that sort of thing? 5
or 6 beds. You're going to need fridges. You've basically got to deck out a large house. So I don't know what that's going to cost, but I'm sure a ticket to China will more than
cover it. And you just get a container, fill it, and then send it over there.
Fill the shipping container up.
And will you meet the container on the other side for the move in?
I've got to work out the timeline, but you'd probably need to.
You probably want to sort it out.
Yeah.
So these are dynamics of like having property in other countries, right?
Yeah.
So you nice views, all that sort of stuff, like a proper.
Yeah, it's typical like Greek villa, what you think it's going to look like. So it's got the vines up one side. And
okay, so that's Greece. That's cool. So that's more of a lifestyle asset and you generate income through it if you Airbnb it. Yeah. Then you got the challenge of how do you get the income back here or do you leave it there? Or
it'll be through the Airbnb.
Money, right? Yeah. That's all right, yeah. So it just goes in a central account, doesn't it?
Exactly.
All right, I'm going to get a quick break, so I want to get into these commercial properties. Back in a moment. Welcome back, everyone. Here with Scott O'Neill. We're talking properties in Greece and the balance of a portfolio having some lifestyle assets in there and maybe dabbling with a little bit of Airbnb type stuff, which is becoming very popular. You don't need to go to Greece to do this stuff. You can just buy yourself a nice coastal house somewhere on the coast, the east coast of Australia or wherever. But commercial properties, which is a area that you've been building out your portfolio in from when we got together in March, you've added 4 more properties. You happy to talk about those ones?
Yeah.
Give me some numbers and stuff.
Yeah.
Yeah. Okay. First property that you bought, commercial. What was it? Where was it?
So bought up in Rockhampton, a paint shop. So it's one of the showrooms. It's got like Bristol paints. Basically all the big brands. So that was around sort of 800,000.
Okay.
And 7.5% net yield. I bought that one because number one, it was a large space, fully decked out. So it had a quite expensive fit out. 7.5% net yields. Highly positively geared too. So after all costs, that's, about, $700-800 a week in your pocket, and it's increasing 4% a year rents, 5-year lease to an international company. I thought that was a no-brainer really. And if they ever left, they're, it's just one of those places you could have one of those like Husqvarna type places or, any type of bathroom, showroom, there's a lot of businesses that need high exposure type properties. And
what's the location? Is it like on a main drag or is it industrial area? Yeah,
main drag. And it's got that warehouse side of it too. So there's definitely options probably to even split it. You could have the showroom at the front, then big storage part out the back.
How big's the total square meterage on it?
About 1,500 square metres.
So it's a big space.
Yeah.
And you said it's already fitted out. Did you get any of the benefits of depreciation of that fit out moving forward? It's already been chewed all up.
Yeah, no, look, you'll definitely claim it. So there's good depreciation with commercial because you can claim on the previous owner's repairs, unlike residential at the moment.
You can't do it. Yeah, that's changed. How did you find that property?
Just an off-market deal. Agent, I've known him for years. He just said, look, this one's going to go quick. He knew I was looking because I was basically just had my budget in the air and actually sent it to a couple of clients and they weren't in the position. So I actually was looking for about 6 months and I kept, instead of buying it myself, was sending the properties to clients and they were buying it. So this one, they didn't want it, so I just grabbed it.
Okay, cool. What was the next property after the Rocky one?
So 3 shops in North Brisbane, so up near that Kalanga way.
Okay.
So there's like a little mini mart, there's a hairdresser type. So, and what's the other one? It's just a fast food type business. So I bought that because they're about $350 each. So they're, good land component. I like the North Brisbane area, even for the residential markets. There's a lot going on, as you know. I know you've invested up there. There's got the Petrie Uni. There's, that rail line that's going in. So there's a bit of activity. I think commercial property will benefit from that.
Where in Kalanga is the location?
Oh,
so I know there's a set of shops near a property I bought off Grady Street. It's not sure. Like that way, is it?
So it's not too far from the station up there. Just trying to picture it.
Yeah, I got James, our producer here. What's the numbers on Kalanga in Queensland?
We'll just check that up.
Yeah. So how did you find these properties?
Same deal again, just off-market deal.
Off-market stuff. So it's a fish and chip shop.
Yeah, a little supermarket and a hairdresser.
Okay.
Yeah.
And all separate titles?
Yep.
Okay. All owned by the same person though?
Yeah. So the idea with that one, I'm probably just going to tidy up the leases. There were pretty average leases on it, to be honest. So a couple of them are expiring next year and then one's 3 years. So the idea with value add with commercial is you can buy weak leases, turn them into strong ones, reposition it into the market. I actually don't even think I'll sell, but if I want, I think, anything where you're putting a 3 or a 5 year lease back on the market, you're going to get more money for it if you wanted to.
So what's the process of doing that? Do you just go into the sitting tenant and say, renegotiate the lease, lock them in for a longer period of time, give them some terms or incentives to do that,
exactly,
and then you shore it up? That's pretty much it.
Yeah, so incentives are sometimes part of life with commercial. So you might offer them 3 months rent, or, let's say they want a 3 year lease, but you really want them on a 5 and they're happy. You might just say, you don't have to pay me for January for the next 3 years.
Okay.
It's just like a business negotiation. It could end up any direction, but if the business is happy, making money, they're going to probably want to stay. So you just want to work with them. So it's not really an iron fist type negotiation scenario. We just want to make them happy, and there's many ways to do that.
Yeah. Sorry, James, what are the numbers? I know we're talking commercial. There are also resi numbers on Kalanga. I'm quite
so we've got median house price sitting at $395,000. Seen a negative 0.25% growth over the quarter. Over 12 months, we've seen a negative 0.19% growth. Over 3 years, 8.22% growth. Over 5 years, it's seen a 16.18% growth with a 10-year average annual growth of 1.29% and a gross rental yield of 5%.
It's not really performing too well residential, is it? It's about to though.
Yep.
It's about to. It's got these great shops up there now and stronger leases. So, that's interesting numbers. We're talking commercial, but what's the relationship? A good question. What's the relationship between commercial investments and sort of residential dynamics? So if markets shift and you get a different type of a gentrification of an area, for example, or someone like Kalanga, which will see some growth over time because of some of those things you mentioned around the universities and train lines and all this sort of stuff, will you get an uptick on commercial properties as a result of that?
Yeah, so the businesses will do better. The more people that live there, the more medium average income, particular places like restaurants or, those kind of like discretionary spending type businesses, when the incomes grow, they'll do better. So yeah, that's, as the population increases in that North Brisbane area, I think there's a lot more houses going in than commercial land. So the commercial should benefit quite a bit, I'd say. And look, it's really about just the businesses doing well. You're there for the 7-8% net yields, and if it grows 3-4% on top of that, it's a good day.
So how do you assess whether or not the tenant who's in there is the right sort of tenant? So, whether their business is up, down, left, right, whether there's opportunities for growth, you want them to pay the rent. Is that the extent of it, or you actually want to know more about the business?
So one thing I'd always try get from the current owner is bank statements or at least rental receipts to see the timing of their payment. Because if they're paying in the first 3 days of every month for the last 12 months, that's a pretty good indication they're going to do that when you own it. So a lot of the times you can see tenants that are very late paying, or, they're not consistent. That's a red flag, because they're probably going to be worse when you're got the property. A lot of just on the ground research, like going to see these properties, especially when it's retail related. Like I don't go look at all warehouses, for instance, because you can,
you sort of know what it's going to be.
Exactly. And you don't care about foot
utility.
traffic and stuff like that. But a good retail asset, like, a shopping centre, if you need to go just sit in it, have a chat to the cafe owners and that, they're always going to be the most negative, I've found, because especially if some random starts asking how business is, like what benefit do they have to say they're going great? But it's still good to hear what they've got to say and just take it on board.
Do you normally go into, say, this supermarket or this sort of cafe up in Kalanga? Do you go in there first, as in just a punter having a little nose around, and just as a customer? And
yeah, you try to get there an hour before the agent, especially like when we've been involved in larger assets for, like we'll talk about later about the syndicates. We really want to actually meet the managers of things like a supermarket, because that's huge. A bad manager running a business, even if it's part of a national network, can be, it's probably the major factor with these businesses doing well or not sometimes. Yeah. So having a chat to them and getting a good vibe from them is important. The rest is just walking around and just using the old common sense thing to see what it looks like. If it looks dead, it's probably not a good sign.
And is that iffy for the moment on commercial stuff, or are you always out there looking?
Oh, for now, I'll probably just go more into the syndicate side, just because it's almost like shares.
Yeah.
You're not actually having to go in and pull apart properties and get bank loans and stuff like that. It's just a matter of putting money in and getting a monthly or quarterly return.
And we'll get into syndicates in a moment, but just on these properties that so one in Rockham and 3 sort of collectively or side by side in Kalanga, is that sort of putting all your eggs in one basket? People talk a lot about diversification. Now, Rockham's a long way from Kalanga.
Yep.
Both in the same state. Is there too many assets in one location? Like, it's a big punt, isn't it? Or was the deal too good to be true and you grabbed it?
Yeah, look, it's a good deal, and I've got a very wide spread. So, I've got 32 different properties, and, some in Perth, some like ACT, New South Wales. So in the grand scheme of things, it's not a large quantity in one area. But I think I like the idea of owning a few in a row, because you control more land in the one spot.
So it's like land banking as well. So you could knock down all those things and have one big supermarket, really. So it gives you options moving forward.
And that's a genuine exit strategy or end game type scenario.
And that would be sort of the asset that an Audi would buy, right? It's probably the right sort of square metre or some other smaller supermarket to capitalise on that. Did you pay each of them individually, or did you bundle them all up and just do a top?
Yeah, so it was about $1 million all up.
Okay, for 3 assets. It's returning you how much a year now?
Oh, that one's about 65, so a little bit lower yield. Yeah. Right? 6.5's a good yield still, when, a mortgage on a commercial loan is anywhere from 3.2 to 4% at the moment.
So you're getting a pretty reasonable sort of margin on your debt.
Yeah, exactly.
Which is good. That's the cash in your back pocket.
Yep.
So the money that the positive cash flow you're generating out of your commercial assets, are you just using that to put down more deposits for more commercial, or are you looking to put that into the syndicate stuff?
Yeah, that's sort of what I've been doing. It's just almost like saving. Part of what helped me fund those purchases was, one was in a super fund. So that was just literally just money I used to have with a industry fund, retail fund. Yeah. So I just got that out and then purchased a commercial property. So, and that was a really good process, because the lending was just very hands off, to be honest. It just got a 75% lend on that. And
is that the paint shop one? Did you put
yeah.
Okay.
So literally it was a 2 to 3 week process with the loan, and it was done.
What rate did you pay on it?
So it was a 75% loan, I think 20 or 25 year term. So it could have even been a 30-year term. So really good lending. The rate was up around the 6%.
Yeah.
So higher.
That's what you expect on a super.
Yeah.
Yeah.
But the numbers still work.
Yeah. Okay, let's have a chat around this syndicate stuff, which a lot of people may have heard of, but not very familiar with. But we'll just go to a break beforehand. Back in a moment. Welcome back, everyone. Here with Scott O'Neill. We're talking Greek properties, commercial properties in Queensland, but an expanding focus of Scott in his portfolio is getting involved in syndicates. What is a syndicate?
So it's basically you get a group of people, purchase a larger asset that they couldn't have otherwise afforded, and there is normally a bank loan which has no attachment to someone. So a non-recourse loan, they normally run at 55% debt, and then you're buying the property, hold it for like 5 to 7 year periods, and then it's almost like a vote where you sell it or hold on to it or revalue it. Depends on the structure. But they're like a unit trust type structure, and you distribute funds monthly or quarterly.
Okay, and talking commercial stuff.
Yeah. Because you want the good cash flow from day one. Like there's syndicates for developments where they might pay you at the end of the year or end of the project. To me, it's too risky. I'd like to see return on money day one, and that's what a tenanted property will do.
Are you leading the syndicates, packaging them together, or are you just a passive person who someone else is doing all the hard work, you're just ponying up the cash?
Yeah, so we'll find the property and package it together. I find You can go to large, funds that have got billions under management. But what I've been finding, a lot of those large businesses buy quite low yielding properties. So, and they've got a heavy fee structure, and there's just...
So the asset manager's making the money out of it, and the investors are probably getting a little bit...
Yeah, and there'll be a fee in this, but it'll be more... It's a different type of property. So instead of buying a 5% yielding office tower, like some of the big industry funds will do, we'll go look at an 8%, and it might be an industrial complex of 20 tenants, or a shopping centre with 15 good tenants. It's about sort of having a higher return. And I think in that sub $20 million range, there's often better returns than the above $20 million range. And it's because you're not up against the institutional buyers.
Yeah, so they're not really getting that down, because they'll be talking about economies of scale and, to have a whole bunch of smaller assets versus one larger one is the way that they would view it. So you're dabbling or moving in that sub 20. Are we talking like always around 10 or sort of always up towards 20?
10 to 20.
10 to 20.
It's sort of a nice sweet spot where no individual tends to be able to afford it. And it's not worth the time of $1 billion fund to purchase, because they want your $50, $100 million assets, because they normally make a 2.5% acquisition fee out of it when they've got huge overheads. And it's the same work sometimes to do a $100 million property to a $20 million one sometimes. So yeah, I like the idea of just having less investors in a pool, and you just got more control, a higher percentage ownership. Yeah, and it's quite popular because a lot of people really need that safe income, and especially with interest rates dropping to where they are, to get a 7.5, 8% net yield paid monthly or quarterly when it's spread between 20 different tenants. That's quite attractive for many.
So you set up a unit trust, and the unit trust is the entity that takes on the debt, and then whoever is in, based on their percentages, get a distribution as positive cash flow comes in based on their percentage of the ownership.
Yep. So
after debt's paid.
Imagine you've got 200 grand and there's a 50% debt in the syndicate. You're effectively controlling 400 grand of asset. So it's almost like a free loan as well. So those who don't want to go through a lending approval process, again, it's another advantage. But look, there's pros and cons. Like, I think direct investment will always, in a long story, probably be, it depends on the asset, but you can leverage more, you can control 100% of the asset. There's more risk, there's more, it's just, there's massive pros and cons to between each.
But the question to you would be, these 10 to $20 million assets, right? Commercial assets, allows you club together, and therefore you can participate in that. If you could buy that without doing a syndicate, would you prefer to do it directly by yourself, or do you think the syndicate gives you? Yeah,
the syndicate just allows you to probably spread your risk out further. You might buy into 4 different large assets, but small amounts. You might put 100 grand on 4 different ones.
So how do you trade in and out of the syndicate? If you need your cash out, you got to find someone to replace it.
Yeah, it's all done through AFSLs, so it's done properly. So there's normally an agreement which is clearly known at the start. If someone needs money out, you just got to replace it. So someone like myself, I'd try to work with that person to get them out and replace them. So your money, you just got to plan long term. You don't invest in this if you want your money within 5 years.
Yeah. And so people need to get out for whatever reason. And, the discussion or the challenge around it is always what's the value of the asset at that point in time, right? And do you just have to do a valuation then, and that's what you use, or is it predetermined at the point of time of entering into
predetermined. So you do get valuations regularly, because there is a true up at the end of the year. So let's say the asset's grown 10% up, you need to notify investors and make decisions from there. Yeah. So there's always going to be a valuation not too far in the distance.
And how do you sort of go about making sure that you don't get the wrong people in a syndicate, like, call it in inverted commas a no dickhead policy, right? Because they can be a real hassle, right? And this might be yourself and 3 friends doing something. That's a syndicate and a unit trust, or it might be something a little bit more structured, which what you're talking about, where there might be 20 other investors and you might not even know half of them, any of them, all of them. How do you make sure you don't get troublemakers in a syndicate? What's the checks and balances or the red flags for you?
It's probably like any business, like yourself. You're not going to work with any single person. You're not going to employ anyone. Like, it's a process. You'll chat to them, for instance. There will be an information evening, or even just a correspondence over the phone. And if they know the risk, they know what's like, it's all going to be outlined very clearly. So There's not much they could really do to affect it, I guess. So it's probably not. It's not like a JV, and I think that's sort of what you're...
It's a big difference.
Yeah, JVs are more like you're in it together, shoulder by shoulder, like year after year. So this is more, it's a little bit more passive.
Yeah, and I guess that for our listeners who are sitting there thinking this this way beyond them, a super fund in many ways is just a syndicate investment, right? Like you give them your money and then they go and park it somewhere. So if you've got shares in AMP, there's literally tens of thousands of other people with same shares in AMP. You're part of the same club together asset.
Yeah. And I think this is such a good almost alternative to shares because, you want to research the company you're investing in. Like with this, especially with your listeners who are quite knowledgeable on property, they can actually see the asset. They can go to it. They can, they know what they're investing in. So there's a lot more control. They can look at the valuations. They can look at the building report. There's a lot more control, and I think that makes me feel better than sinking $100,000 on Combank, for instance, which I don't know what's going on ever with that stuff.
Yeah, you got to have a lot of time to be really educated on that sort of stuff. So is there much for sale in that sort of 10 to 20 million like bracket, like little regional? We're talking about little regional or suburban shopping centres, industrial parks, or those sort of stuff. Is there much out there?
Surprisingly, there's not much good quality stuff. So there's a lot of, every week I get sent probably 2 or 3 different homemaker centres, maybe 3 or 4 different shopping centres, anywhere from like 5 mil to much more. A lot of the yields are dropping. So that's one, I wouldn't say concerning, but probably a positive thing for the future growth of the market. People are paying more and more for these assets. So, a good asset in, let's say, Brisbane with a Coles or a Woolworths in there, that's 5.56% if you're absolutely lucky at the moment. If there's a KFC, the yields are compressing. And
KFC's good tenant.
Yes. Then they normally got 15-year leases, and it's just hard to think. There's not much value add on those types. So for a syndicate, you sometimes want value add. So
we can spend a few bucks on it to lift the whole ability to generate income out of it and the value of it. Are you able to, and look, we're just touching on this stuff and there's a lot more into it, but if you think about commercial, this is stuff you need to be thinking about. Is there any way you can use the equity you have in a unit trust around a commercial property to leverage yourself into other debt?
In terms into a syndicate?
Outside of a syndicate. So once your money is inside the syndicate,
yep.
It's pretty much done and dusted. Does it affect your lending capability? Do they consider your exposure to that syndicate and the 50% of that debt that you're responsible for?
Without being an accountant, the way I'd look at it is you're not actually acquiring debt. It's more of a pure income. Yeah. So if you put 200 grand cash into it, yes, you're controlling 400 grand of asset, but you're getting 8% on that 400 grand.
After the debt's paid down.
Exactly.
Yeah. Okay. Maybe you should write some stuff for us on smartpropertyinvestment.com for people who are interested in this thing, because as people go down this journey of creating wealth through property, as I mentioned beforehand, they start sort of thinking a little bit left of centre.
Yeah, and I think it's a very timely thing as well with these interest rates dropping and yields getting worse, and probably people's risk tolerance in the market is, getting smaller. So this is a way of diversifying. Like I said, I'd never steer away from direct investing to commercial because that's where I think you can get the best returns. But if you're more conservative, this is a secondary option.
To be. Okay. Well, thanks for coming in and sharing what's going on. Get you again in about 12 months' time.
Sounds good.
How many more properties are you going to have then?
Oh, no plans to buy. So
okay. All right. Well, you got other things top of mind now, and you'll be busy at home. But again, congratulations on the new addition to the family, and appreciate you coming in. Thanks, Scott.
Thanks, Phil.
Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to the morning newsletter, Smart Property Investment, so you're the first to know what's going on in property right across Australia, smartpropertyinvestment.com.au/subscribe. And those numbers that James are rattling out, they're all available on Smart Property Investment. Just go to the website and click on the best suburbs, and you'll be able to search 4,000+ suburbs right across Australia, houses and units. It's a great resource. Go and use it. Go and check it out. It's what I use to do all of my property research, or a lot of my property research. Social media, Smart Property HQ. Track us down there. And if you like what we're doing with this sort of stuff, happy to have more commercial discussions. Reach out to us on Facebook or directly to the team editor Richard at smartpropertyinvestment.com.au. And the one thing that you can help me out with is please keep those reviews coming on iTunes or wherever you're listening to this podcast. The team here get a real kick out of it. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.